It's all about tax avoidance, and if you can figure out a better mousetrap to avoid any tax liability, especially estate tax, transfer taxes, you should really take a look at it. In some of my more recent syndications with high net worth families, I noticed that all my investors are trusts. so, and they're done purposely to bypass probate.
So talk about the importance of looking at investments and making investment decisions with a 3D approach with all three of these aspects.
No, sure. I think that one thing any investor needs to do is look at the underwriting and stress it themselves. They should say, what if interest rates went up? If it's not a fixed rate loan, they should say, well, what if interest rates moved up 300 basis points? What does the debt service look like? Am I going to have a trouble where I might face a future capital call? Or if I can't make the capital call, am I going to get liquidated down? They should also make sure that whoever the sponsor is ordering a cost segregation report to try to take advantage of any accelerated depreciation that's going to get passed through, and to also make sure that the sponsor isn't keeping all the depreciation, because I've seen a few of those tricks also, where you should be getting depreciation that's a pass through, which will offset hopefully a good portion of your current income from that particular investment. And then to the extent that you're getting excess depreciation, especially if it's an asset that you can really accelerate, that you can use that for offset other passive income that you might have that doesn't have any shelter from depreciation. And if you're going to sell, always, if you're a significant enough investor in a deal, always ask if they'll give you a TIC, a tenant in common interest, because that gives you the more flexibility to exchange if and when the asset is sold, and not be tied to the rest of your partnership and have a taxable event. It's all about tax avoidance. We've been exchanging some of our assets for over 25 years and continue to grow the value there. But eventually, I think maybe some generation might have a tax liability, but we're trying to work around that. But in the meantime, we continue to exchange.
Yeah, let's dive right into that, because part of the topic we really focus on, we're really passionate about, is capital gains tax solutions. And you mentioned cost segregation, you mentioned 1031 exchanges, and you mentioned just overall, tax flow strategies there to offset the cash flow. However, there's some limitations to some of these things, and I'm curious what your thoughts are on this. We found that once you fully depreciate, multifamily is 27 and a half years, and you've done exchanges, the old depreciation schedule travels, you run out of that tax flow to offset the cash flow. So there's nothing to cost seg anymore unless you had bought a much bigger property and perhaps taken on a lot of debt, which could be problematic in that. However, the other one that gets mixed up a lot is the estate tax, the death tax, right? We're working with some owners now. And as a reminder, as of 2026, the exemptions are perhaps resetting or going back down to set to expire to about that 5 to 6 million single individual, about 10 to 12 million married. And so this is what's called the government's biggest mousetrap, is this debt tax. And so you might build up $100 million with a portfolio of multifamily, but if it's inside of your taxable estate,
correct.
And if you haven't bought enough life insurance, if you haven't gifted enough away, or you haven't given it all away to charity, it becomes this big burden for the estate. So we have a solution. It's called the DST Plus. Okay. Not a Delaware statutory trust, but allows you to sell an asset, Irwin, eliminate that estate tax forever. No charity, no gifting, no life insurance required. It does take a sale of an asset while you're still alive. Not only does it do that, your kids inherit it estate tax free, but also you can partner with this trust to go buy more assets with a new depreciation schedule, resetting your depreciation schedule. Okay. Now you get about 80% of that the way that it's structured, remain within the guardrails of the structure. But when you hear something like that, Irwin, being that you've been in the business as long as you've been, what comes to mind?
It's all about tax avoidance, and if you can figure out a better mousetrap to avoid any tax liability, especially estate tax, transfer taxes, you should really take a look at it. In some of my more recent syndications with high net worth families, I noticed that all my investors are trusts. and they're done purposely to bypass probate and the estate tax. they're qualified, whatever, qualified residence trust or personal holding companies or revocable trusts, irrevocable trusts. And I've asked enough questions, and they're all trying to work with different tax people on how to avoid tax on their demise. And I think that's very important that most people don't think about. I know a lot of people that carry, many years ago, bought the old-fashioned second to die life insurance, which on the family level between the spouses to sort of pay for any estate taxes. But now I think it's important to put your home and everything else into a trust, especially not only for estate tax purposes, but also, God forbid, you need to be in any kind of care facility as you get older, that they can't make you liquidate everything. So it's all about structuring to protect your assets for your future generation, if that's what you want to do. Some people are still of the old school that, well, my kids will make their own money. I'm going to take my last breath as I spend my last buck. I still see a couple of those every once in a while.